Introducing a new era for discerning Australian investors. Brought to you by Ausbiz and backed by deep market insight, professional analysis and a proven track record. Our focus is simple: to connect you with exclusive and compelling investment opportunities. Discover what's next at ausbizcapital.com.au. This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz as we get across what is going on globally, with news breaking this morning that Iran and Israel have agreed to a ceasefire. That was announced by US President Donald Trump, saying they've agreed to a 12-hour ceasefire, and that has sent Wall Street futures higher. The US dollar has eased as a result also, and in fact the biggest mover being oil. They initially slid 9%. That was after a token retaliation against the US airbase in Qatar, and they've fallen yet another 4%. So oil plummeting at this point, with Iran appearing not to follow through with threats to close or at least disrupt oil traffic on the Strait of Hormuz. The Aussie dollar has risen, as you can see, up around 1/3%. And overall, this follows improved investor sentiment as Iran launched retaliatory attacks against the US air bases in the Middle East, which were successfully intercepted. The oil market, as I mentioned there, taking it as a sign that Iran are unlikely to follow through with threats to disrupt exports. And overall, global equity markets were higher on Wall Street, investors further buoyed by prospects of the US Federal Reserve cutting interest rates as early as July. I'll get some greater detail on that in just a moment. All three of the major stock indices there sharply higher, led by consumer discretionary stocks. Among the Mag 7 stocks, Tesla was the clear leader after the long-awaited launch of the company's robo-taxi service in Austin, Texas. The EV maker's shares finishing more than 8% higher. Northern Trust jumped after a Wall Street Journal report said Bank of New York Mellon broaching the topic of a potential merger. AI server maker Supermicro Computer fell heavily after it announced a private offering of $2 billion in 5-year convertible bonds. Quarterly results from sportswear company Nike and package delivery firm FedEx are ahead later in the week, so they're in focus this week. And the oil majors, well, they did reflect that drop in crude prices. Halliburton down some 7%, but to further falls there after the market closed, and among the defence stocks ending in mixed territory. Well, Iran has failed to follow through with threats to disrupt oil and gas tanker traffic through the Strait of Hormuz, but instead has attacked US military bases in Qatar and in Iraq in retaliation for the US attacks on its nuclear facilities. Iran's missile attack on the Al Udeid airbase in Qatar was intercepted with no casualties reported. US President Donald Trump dismissing it as a weak response to US attacks while urging Iran and Israel to make peace. And of course, since then, he has posted on social media that there will be a ceasefire between Israel and Iran, at which point he says the war would be considered ended. However, Israel has continued its air assault on Iran, hitting more targets in Tehran. Well, investors on Wall Street appear to be more interested in comments from the Federal Reserve, with Vice Chair for Supervision Michelle Bowman saying the time to cut interest rates appears imminent, saying should inflation pressures remain contained, I would support lowering the policy rate as soon as our next meeting in order to bring it closer to its neutral setting and to sustain a healthy labour market. While fellow Fed member Austin Goolsbee said the surprise has been so far at least that we've had 3 months of inflation data where there hasn't been much inflation at all. If we do not see inflation resulting from these tariff increases, then in my mind, we never left what I was calling the golden path. Well, yields on US Treasuries fell in response to those Fed comments. The 2-year at 3.81%, the 10-year down to 4.34%, and the US dollar also falling, while it came under further pressure on the prospect of a ceasefire between Iran and Israel. The Aussie at 64.9 US cents, and risk on sentiment has seen Bitcoin climb to above 105,000 US dollars. As I mentioned there, oil price initially falling 7%, losing more than $5 a barrel after Iran took no action to disrupt oil and gas tanker traffic. With geopolitical risk premium coming out of the price, Brent crude futures closing down close to 9% in after-hours trade. Copper was up more than 1%, iron ore rising marginally to $93 a tonne there, and gold initially gaining but has since fallen back to around 3,350, obviously on those easing geopolitical concerns. Well, for more on those risks of current geopolitical events, but also the capital outflows we've seen from the US recently, I caught up with Juan Correa. He's the chief strategist at BCA Research.
There's a few signs that we've seen that investors have begun to repatriate funds outside from the US to their home countries. The first sign that we're seeing is the performance of different currencies in the different sessions. So, for example, if you look at the performance in the euro during the New York session, so in US trading hours, the euro actually hasn't appreciated much this year. Most of that appreciation has come during the European and Asian session, which tells you that it's foreign investors who are selling the dollar and starting to buy other currencies. You're also seeing that the currencies that has appreciated the most so far this year are the currencies that belong to countries with very positive net international investment positions, so with a lot of foreign assets. So that's the Taiwanese dollar, obviously the Swiss franc as well. So we've seen a dynamic where a lot of the currency moves this year are being driven by these flows.
What is it, though, about the US perhaps that's leading investors to boycott the market there? I guess particularly, is it that US debt situation in light of the fact that this bill is coming, the so-called Big Beautiful Bill sponsored by Donald Trump, that is likely to exacerbate that problem?
Well, I wouldn't say it's the bill so much as the valuations, right? So if you had told me to start this year that U.S. assets were gonna underperform, everybody who just looked at valuations would have agreed with you. U.S. assets are extremely expensive, where you look at equities, whether you look at fixed income, where you look at the dollar. And now that's been true for many years, but what's really happened is that the policies of the Trump administration have caused investors to reassess those investments into the dollar. So a lot of investors are saying, well, does it really make sense to have 75% of my assets on U.S. equities where they have safe haven valuations, but the policy is really emerging market like? So that is, for example, what you talk about the debt bill, but also the tariffs and potential to capital taxes on capital. So investors are sort of just saying these assets at these prices don't make much more sense. And there's also the fact that assets in the rest of the world are starting to become much more attractive, whether it's in Europe or whether it's in Asia. So that is causing really those outflows outside of the US.
Well, what is your view on the US dollar, given how far it has fallen? What are the fundamentals at play, and where do you see this going?
So, it's become now consensus to be bearish on the dollar. So I think for the next 6 months or so, we're going to see some stabilization. But I think long term, we're going to continue to see a decline in the USD. And according to our calculations, if you look at the USD, it's overvalued by about 24 to 20%. I think it's quite likely that we are at the early innings of a structural dollar bear market. The flows out of the US, that sort of safe haven quality that the USD used to have, it doesn't seem to be there anymore. The USD has really behaved this year like a risk-on asset, just like the Turkish lira or like the Argentine peso. So I think with that more risk-on nature of the USD now, it's totally unreasonable to have a valuation that high for the dollar. And so even though there's some stabilization because there's a lot of people on that short side right now, I think long term we're going to see the dollar depreciate meaningfully, as I said, by about 20 to 30% over the next 5 years.
One, of course, geopolitical risk remains front and centre at the moment, not the least, of course, what's playing out in the Middle East. How is that likely to influence those capital flows?
Well, I think what's happened so far in the Middle East is great evidence that the world is multipolar, right? So Israel, which is some people would call a vassal state of the U.S., has completely revolted against the Trump presidency. So they attacked Iran, even though Trump didn't want to. And so what this is showing is that countries are willing to bypass the approval of the U.S., which means that we're no longer in that unipolar world that we had over the last 10 to 20 years. I think it was very telling that even in a very serious geopolitical crisis, which is what happened to Iran just in the past few days, the dollar didn't really rally much, right? So Euro USD is close to 116 right now. That is telling you that there's a lot of these structural forces at play in the dollar, and that the dollar is just not the safe haven that it used to be in the last 5 to 10 years.
Well, in fact, I see you go to the point of saying that transition to a multipolar world will actually crush the US dollar, and it's certainly in terms of favouring those non-US assets.
Yeah, and that's the conclusion that my colleague Marco Papic and myself came in a recent report, that as we transition across geopolitical regimes, as we move from unipolarity to multipolarity, the asset that is most likely to suffer is the USD long term. And the assets that are more likely to benefit are those international assets in Europe and in China.
What are the other scenario, potentially of a transition to a bipolar world? What are the implications?
So if we were to go to a bipolar world, I think that would be very different, right? So in that scenario, we calculated that the dollar would depreciate somewhat, but not as much as it would during a multipolar world. But the big loser there would be Chinese assets. So in a bipolar world, China would essentially become uninvestable. Now, our view is that a bipolar world is actually quite unlikely. The reason is that China does not have enough allies on its camp in order to really, be effective as a counterbalance to the U.S. China would just have countries like Russia, like Iran, and maybe a few countries in Asia on its side. And then it would have to essentially fight with the overwhelming force of the West. China does not seem that it wants to do that. In fact, we've seen over the past few days that China is actually quite unwilling to help Iran. It does not want to create a coalition that opposes the West. It wants to sort of create this path where it's able to deal with many different countries. And so we think that a multipolar world is actually much more likely than a bipolar world, because it is not in China's interest at all to enter such a divided regime.
So what are the opportunities you're seeing in China at the moment, perhaps with the prospect that further stimulus will be unleashed?
Yeah, so I think there's quite a bit of opportunities there, especially in the equity side. So people always compare China today to Japan in the 1990s. And in terms of the economy, they do look very similar, right? So they have poor demographics, their economies are slowing down. However, when it comes to the markets, they're completely different. So China today is trading at barely double digits when it comes to PE, whereas Japan, after the bubble popped in the 1990s, was trading between 30 and 15 PE. It was extremely expensive. And if you actually see the reason why Japanese equities did so badly over those 2 decades after the bubble popped, it wasn't earnings. Earnings actually did pretty well. It was all multiple compression. Multiple compression is not something that we should expect for Chinese equities. They're already heavily discounted. So I do think that given all that essentially pessimistic sentiment on Chinese assets, on the Chinese economy, any surprises, whether it is from a deal between Trump and the Trump administration and Xi Jinping, or, as you said, stimulus, could very well provide a big boon for Chinese equities going forward.
And Juan, just to sum up, look, also obviously tariffs yet to be resolved. That July 9 date looms, the deadline. that Donald Trump has imposed. How do you view that as is likely to play out, of course, with the markets embracing that so-called taco trade that Trump will eventually back down? Do you subscribe to that?
Well, my view, Andrew, is that tariffs have actually not been, they've been more for day traders rather than for asset allocators. So we've had changes. Tariffs have changed 20 times this year. The effective tariff rate has changed 20 times. So, it's been great if you've been a day trader, but for asset allocators, to me, focusing too much on tariffs has not been that effective. To me, it's much better to focus on those fundamental factors that we talked before. Because, ultimately, the Trump administration does want to rejigger those trade relationships, but he does not want to destroy the U.S. economy. And he does not want to destroy the Chinese economy either, right? So the Trump administration is actually quite pragmatic in its approach and is seeing tariffs as a tool rather than an ends itself. And so, going forward, we're going to have a lot of ups and downs when it comes to tariffs, but, ultimately, I do believe that the Trump administration is going to want to achieve a deal with China, which would be sort of the best price that the Trump administration could get from these negotiations. And, ultimately, that is going to be quite good for markets and is going to be quite good for Chinese assets in particular.
Juan Correa from BCA Research. All right, let's check the local market. We're just getting going. In fact, despite futures indicating a strong start, so up 0.75%. Just a reminder too to join our next virtual investor event, the ABCs of derivatives. Derivatives can be used in your SMSF strategy. Can also be used for downside protection, extracting yield, and for leverage. So you can join our virtual investor event to discover how to achieve upside after learning the ABCs of derivatives. Join us on Thursday, June 26th at 1 p.m. Eastern. Registration is free. And if you are registered, you can watch live or on demand at ausbiz.co/derivatives. Stay with us for the open.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.